we will continue advancing in this Accounting for Decision-Making and Control course at Blackwell Global University within its MBA program. Well, in the previous sessions, we were looking at two major topics that are completely interconnected with each other, of course. On one hand, accounting, and in particular financial accounting, along with its various components. Essentially, income statement, balance sheet, and cash flow statement, cash flow. On the other hand, the entire world of financial analysis. The way we can interpret and make sense of the numbers generated by accounting. And now in this area, we are going to review everything related to the vast world, which is not always a world that is necessarily understood sufficiently. Valued. That is the world of cost accounting. So let's move forward. Here, and what we are going to see here has to do with how we relate in detail accounting in different types of costs, how we classify costs, a brief exercise on cost allocation, evaluate and thoroughly analyze what specific order costs and joint costs are. So, let's start with an example here. Let's assume that you are the owners of a convenience store and you have one person who works for 45 hours a week and is paid 200,000 pesos per month. In addition, you have a supplier that sells you 3 different products. One for 80, another for 60, for eating, and juices for 120. So, the question is, well, what costs do we have when owning this convenience store? And how would we calculate the selling price of the products? In this very simple exercise, of course, various costs and expenses are missing. Rent, or the expenses associated with owning a commercial property, are absent. Things like the water and electricity bills are missing. And another expense. That one obviously incurs for managing or operating a convenience store. In this very simple example, where we buy 3 products and sell 3 products with a margin, in real life it often becomes complicated to determine the costs and to arrive at the selling price. Indeed, there are quite a few companies that sell products or services at a loss. But the worst part is that they don't know it. They don't know it. They even believe they are selling it with a good profit. So, many times this is an unknown topic, and entrepreneurs in general allocate few resources or little dedication to understanding something as key as knowing what my costs are. What is my cost to produce a good? Or what is my cost to sell or distribute a certain good? And that is what we will be talking about in this chapter. So, to get into the subject, one might think, well, what is a cost? In simple terms, all the money and resources that the company uses to manufacture and sell its products and services. How does it help us? For many things, including setting prices, to reduce and control costs, to make decisions, to plan for the future. So, there is an important area that lies behind these concepts that we are discussing here. So, perhaps we could start with cost accounting. That is useful information for making decisions both for external users and internal users of the organization. In this regard, we must understand that the information provided by a cost accounting system has various purposes. On one hand, to value the products that are in the process of completion as well as the finished ones. And of course, it allows us to assign a value, a selling cost to the products we are selling. Another purpose of cost accounting is related to management control through the comparison of, for example, a budgeted cost and an actual cost. I budgeted that such a product would cost me $1,000 per unit, but Expos cost me $1,200. What happened? Why is this deviation explained? What can we do to improve this? Next, a third objective here is planning based on budgets. And finally, to provide information that helps us in decision-making, operational, tactical, and strategic decisions. In this sense, cost accounting must provide useful information for financial accounting as well as for management accounting, right? This is the accounting that is kept internally within the organization. On the other hand, right, remembering what we saw at the beginning of the course, we know that financial accounting provides information to external users of the company. This refers to the figure of shareholders, banks, suppliers, and government entities. This information consists of financial statements, balance sheets, income statements, cash flow statements, and also the notes applicable to the financial statements. It is also important to understand that the information provided by financial accounting is governed by certain principles. Nowadays, it is mainly by the international standard, right, of IFRS or NIF, and the information provided by cost accounting is related to, obviously, a very specific and determining purpose in general for companies. We have also noted that there is managerial accounting, which provides information to internal users, such as managers and administrators, but this internal information is not necessarily governed by certain principles like IFRS. And this administrative information relates to cost accounting in certain specific aspects. This administrative accounting is also known as management accounting or managerial accounting. Now getting right into costs, what are the steps that one should normally consider in this cost accounting? First, identify what the cost object is. This cost object can be a product, a process, or a service. First, then, identify the cost object. Second, identify the resources that are being consumed. For example, in a productive goods company, the resources consumed in manufacturing products are associated with direct costs of raw materials and labor, as well as indirect manufacturing costs. Thirdly, measure and accumulate the resources consumed. This relates to accurately quantifying the resources that are being consumed. And fourth, to value the resources consumed. Right, in the sense of interpreting and preparing cost information for different uses, both external and internal. So, there are four main steps that are typically involved in determining the costs of a particular product or service. On the other hand, it is also very important that we differentiate between the cost of a product and the expense of the period. In a company that produces goods, where is the product cost? Well, in the inventory entry of current or circulating assets, both in-process products and finished products. And on the other hand, when products that are already finished are sold, the cost of the product becomes an expense of the period and is charged to results as a direct cost of sales. So here we have a diagram of this cost cycle, where we have certain resources consumed, including direct raw materials, direct labor, and general manufacturing expenses. Then we have a production process where direct raw materials change their natural state from an input, from various inputs to a product. That is in the process of completion until it is already finished. So, from the production process, we can take a snapshot over the entire duration of time, primarily focusing on current assets, having products in process and also finished products within the scope of inventory. And of course, this generates a product cost for us, which we will ultimately incorporate into the income statement as a cost of sales and also as period expenses, but primarily as a cost of sales. Everything that is directly assignable to that product will be recorded as a cost of goods sold at the moment we have a sale and associated sales revenue for that product. So, here we can classify costs in different ways. And here this is important in the present because suddenly there are some who think that there is only one way, one single classification scheme. The truth is that this is not the case. There are different ways to classify costs. On one hand, based on the functional areas, in relation to the functional area. So, for example, we associate costs with management, sales, distribution, and production. This is one way, right, to classify costs. A second way, right, it is associated with its elements. For example, here we will have direct raw materials. What are direct raw materials? Materials that are transformed in the production process, changing from their original or natural state to finished products, and that can be easily identified with the finished product. For example, sheets of steel that are used to manufacture automobiles. Obviously, it is a direct cost. It is not an indirect cost or expense. Also, on the other hand, something as relevant as direct labor will be involved. And here it is in relation to remuneration for this human, physical, and intellectual effort that is used to transform raw materials into finished products. To be considered. A direct maneuver, it must be easily identifiable with the finished product. For example, and following up on what we were pointing out earlier, the compensation of assemblers in the automotive industry, that is, the people who are there on the assembly line, and they are directly, for example, assembling parts and pieces in an automobile production process. This is definitely direct labor, directly associated with the production of those automobiles. Also, of course, not all are costs or direct expenses. We will also have manufacturing expenses, or indirect manufacturing costs, which are those costs distinct from raw materials and direct labor. For example, the bolts used to assemble the steel sheet and the salaries of the supervisors in that department or assembly area. So, they are all costs that are not so direct, not easily identifiable with the finished product, but that are necessary for the production process to take place. Therefore, the first items that receive manufacturing expenses are indirect raw materials, indirect labor, and, of course, they could also include items like the electricity consumed by production equipment and the charge for depreciation of these. So, we have directly related costs, directly assigned expenses to manufacturing, and we need to have manufacturing expenses or indirect costs, which are also necessary, of course, directly for manufacturing. Another distinct way to classify costs is related to production. For example, prime cost, which is essentially the cost of direct raw materials plus the cost of direct labor, or also the conversion costs, which are the cost of direct labor plus manufacturing expenses. correspond to the cost of transforming direct raw materials into finished products. Therefore, prime cost is the cost of direct raw materials plus the cost of direct labor, and the conversion cost reflects the cost of direct labor plus manufacturing overhead, which corresponds to the cost of transforming direct raw materials into finished products. Also, another way to classify them is in relation to how easily we can associate them. So, for example, direct costs, which are those that can be associated with products, processes, the area of execution, or specific activities, and indirect costs. These are common costs associated with products, areas of the organization, or specific activities that impact production, or the delivery of a service, but are not directly linked to those products or processes. Sixth, in relation to the timing when they are charged to the income statement. One example could be the cost of the product, which is presented as assets on the balance sheet. In the inventory account, as we have noted, in work in process and finished goods, or also certain period costs, for example, those associated with administrative and sales expenses incurred in a specific period, but that do not value the products and are not charged to the income statement in the period in which they occur. Seventh, in relation to its behavior, with changes in production volume. And here we can show all the famous fixed costs. These are costs that, within a certain range at least, do not change regardless of the level of activity. And these are the costs that serve to keep, so to speak, the business open. You must be certain that whether production takes place or not, and whether the service brand is sold or not, these costs must still be covered by the company. And there appear, for example, rents, amortizations, insurance, fixed taxes, utilities, salaries, etc. at a certain level. As we mentioned, production range does not change whether I sell 10 or 100 units of that product. And, of course, also the variable costs, right? These are the costs that would occur proportionally at the level of production or activity of the company. These are costs associated with producing or selling, such as direct labor, materials, supplies, specific taxes, packaging, sales commissions, etc. And also, right, according to its behavior. So, we can have the variable unit cost, which is the cost assigned to each unit of product, and that incorporates raw materials and materials used in manufacturing a specific product unit, as well as direct labor, packaging, sales commissions, and direct unit variable cost. And then we have the total variable cost, which is the cost that involves multiplying the unit variable cost by the quantity of products manufactured or sold in a period. Therefore, it is the unit variable cost, total variable cost multiplied by the quantity. And then we can arrive at the unit fixed cost, which is the total fixed cost divided by the quantity, or the unit total cost, which is the unit variable cost plus the unit fixed cost, and the total cost, which is the total variable cost plus the total fixed cost. So, all of these are different ways of classifying costs according to different meanings and various elements. So, having said all this, we are now finishing this first session on the world of costs, and we will continue next.